Well, good afternoon, everyone. I'll talk to you about steelmaking coal markets, as Greg said. Before I start, during this presentation, I will be talking about China a fair bit. And one thing maybe to keep in mind for this year, if you look at the steelmaking seaborne market, the largest importer has been for a long time Japan. But with the level at which China is running this year, it could be very similar to Japan, or possibly even larger. So what I will cover in this presentation is demand and supply. On the demand side, it's looking at where the growth is coming from. A lot of it is driven by urbanization and increased demand for steel and steelmaking coal. And then in the short term, as Don mentioned in his presentation, improvements in some market areas, traditional market areas, and fundamentals as well. On the supply side, the story is really around the price and where the level that it got to and the impact on margins for suppliers. So starting on the demand side, this graph shows the hot metal production increase going forward and the historical going back about 10 years. The blue bars are China hot metal production, the green bars are global ex-China, and the red little bars are the increases that we see that are expected in the next decade. So really, China is expected to keep driving the demand for the production for hot metal and the demand for steelmaking coal. And as looking more closely to 2013, China's hot metal production in 2013 will probably be in excess of 700 million tons. So again, becoming very large. And the rest of the world is also continuing to grow, as you can see on the graph, and India has the larger share of that growth outside of China. This chart here talks about the link between crude steel apparent consumption and urbanization. So if you look at the top chart, it shows that China's urbanization rate was around 53% in 2012, and it is expected to continue to grow over the period, getting closer to where the developed economies are. The bottom graph shows that China's urbanization rate has doubled in the past 20 years, but the bottom table is also showing that there is still ways to go for China. So that bottom table shows the peak crude steel apparent consumption in Japan, Germany, and the US. And it also shows the urbanization rate, the corresponding urbanization rate for those markets at that time. So you can tell from the table that China is still about 200 to 300 kg per capita lower on the crude steel consumption, and the urbanization rate is still around 20 points below where the other three countries were at their peak. Looking more closely at the China steel industry, you may have seen this slide before in previous presentations. So China is continuing to relocate and modernize its steelmaking industry, relocating to the coast to gain access to steelmaking raw materials, seaborne steelmaking raw materials, including coal. And that trend is expected to continue, as shown by the boxes on this graph. The boxes illustrate some of the projects. Some of them have already been partly built, some others are approved and will soon be coming. And the reason why China is moving to the coast, the domestic supply in China has increased this year. However, it's limited by resources. And as you can see on the next slide, there has been a large increase in seaborne steelmaking coal imports. Looking more specifically at 2013, China has imported year-to-date September about double what it did over the same period in 2012. But Mongolia, at the same time, Mongolia is the blue shaded area on the graph. Mongolia imports have dropped about 10% this year, mainly due to price competitiveness and the higher cost of that industry. I talked about India a little bit at the start. A few key points on India. There's around 5 main blast furnace projects that are expected to add around 20 million tons of production into India, hot metal production into India over the next few years. India is now the 3rd largest seaborne importer of steelmaking coal. They've overtaken Korea in 2011. And when you look at India going forward to 2030 versus today, expectations are that hot metal production and demand for steelmaking coal, seaborne steelmaking coal, will be about 2.5 times what it is today. Now, a little bit of a shift here, looking at alternative steelmaking processes. On this graph, the blue bars are showing hot metal production. It increases out to 2017. The red bars are HBI and DRI production and expected increases. So the graph shows that the hot metal production is expected to remain the dominant route, the dominant source for supply to the steel industry. And DRI, granted DRI is increasing at a higher rate, but it is still a pretty small portion of supply for hot metal to steelmaking, and most of it is concentrated in areas that have access to cheap energy. The next slide talks about the shift to lower quality coals in blends. Over the past couple of years, the margins for the steelmakers have been squeezed, and as a result, they have been trying to control cost. And one of the ways they've done that is by increasing the proportion of lower quality coals in their blends. Now, it is possible to do this when the industry is running at lower capacity levels, but when capacity utilization is starting to increase, those technologies are not proven yet. So on top of the utilization rate level, the pricing also, the pricing differential between hard coking coal and lower quality coals can also impact the level of participation of lower quality coals in coking coal blends at steel mills. Because as the differential, if the differential actually shrinks, the benefits of the higher quality coals in the blends may outweigh the savings on the cost of the low quality coal. Last slide for the demand section. I guess in summary on this map, Asia is expected to drive most of the growth in the demand for steelmaking coal, and you can see as well that other market areas are expected to continue to play a large role on that market. Now, moving to supply, most of the producing areas, so that's the black triangles on the chart, have increased their production, their exports of seaborne steelmaking coal in 2013, except for the USA. USA exports, August year to date, are down around 10% compared to last year, and I'll talk a little bit more about that on the next few slides. But looking at other producing areas, Canada, August year to date, is up 3 million tons. Australia is up 15 million tons. They're back up to where they were pre-flood levels. Expectations around Mongolia for full year 2012 is that their exports will increase around 1 million tons compared to last year. The orange triangles on this slide are new projects and new deposits, and they all come with their own set of challenges. So overall supply of high quality hard coking coal particularly remains quite tight on the market. This graph here, the top graph refers to how the U.S. have acted as a swing supplier to counter the supply shocks that we saw earlier in the decade. But with the price dropping over 50% from the peak that it reached in 2011, there's been a lot more pressure put on steelmaking coal suppliers, and especially in the U.S. And that's one of the reasons why their exports in 2013 year to date are actually down by about 20%, by about 10%. Sorry. A number of analysts in the market are also expecting that seaborne exports from U.S. producers could be down to the mid 50 million ton levels for 2013. Now, at the same time as those production cuts have happened, we've also seen low-cost producers increasing production and supply into the seaborne market, and as a result, the market has remained well supplied. Another way to look at the impact of oversupply is the margin curve. So this margin curve is based on a price of $152 FOB. The blue line, the blue solid line, is the latest update to the margin curve. The black dotted line was our previous update to the margin curve. What has caused the margin curve to move is three things. The movement in foreign exchange rates, the coal price increases, and also the cost reduction initiatives that a number of producers have been working to implement. The red line on the slide refers to tons where possibly cost reduction initiatives have not been fully reflected and reported yet. So there could be some improvements on that side. And the black shaded area refers to production cuts that have already been announced. Looking at this slide here, the top chart is an illustration of the margins for the steelmakers. The key point about this is although the steelmakers' margins have been squeezed over the year, actually, if you look at the bottom chart, demand for steelmaking coal has continued to increase. So even though the margins are tight, there is more demand for steelmaking coal. One example, I talked about China earlier. China's currently running with crude steel production, average daily crude steel production above 2.1 million tons. And if they keep running at this rate, their crude steel production for the year could be around 780 million tons. That would be roughly 70 million ton increase compared to a year ago. Don has shown this slide earlier. That's our sales distribution, our sales portfolio for 2012. It shows that we're supplying coal to the majority of the steelmaking industry around the world. We're a strategic quality supplier to a number of markets, and our products represent the largest Canadian exports to Japan, Korea, Taiwan, Brazil, and Turkey. One key point about this is China, in particular, is taking a larger place on the seaborne steelmaking coal market, and it's the same thing in Teck's book. In 2012, our sales were around 30% into China, and our overall sales to the Asian market were around 75%, again, a reflection of where growth and demand are coming from. So in summary, we see the long-term fundamentals for steelmaking coal as continuing to be strong. In the short term, we see improvements in a number of market areas and fundamentals. The world economic uncertainty appears to be easing. Emerging markets are continuing to urbanize and requiring more steel, therefore more steelmaking coal. And in China, with more steel production located on the coast, more demand for seaborne steelmaking coal. And Teck is in a good position, and Ian will talk more about our initiatives at the mines in the upcoming presentation. So thank you. If there's any questions, I'm happy to answer.
Thanks so much, Réal.
I guess I never appreciated how well the coal was marketed in 2009 in a tough market until we got almost to that price level. How was the decision made to sell 900,000 tons in the recent quarter out of inventory around $139? It would seem almost blasphemous to your brand. Was it defective coal? Was there something wrong with it? And who makes that decision, or how do you let the customer bend your arm? And give us some background.
Okay,
given that we buy your stock for the good quality of the coal and the long resource, and when it goes down at a lousy price, it sort of hurts.
So just to answer your question, when we look at the past quarter, actually for 2/3 of the quarter, the spot price was below the quarterly price. So the price trended down until it started to recover. Now, we operate in the market, and of course, if we're selling coal in the market, we recognize that. And one thing to keep in mind too is when we give a price guidance, it's based on the price of coal. It's based on the tons that have been priced at the time of the guidance. Now, the other thing that has changed in the quarter as well, I've shown on one of the slide here that there's been an increase in lower grade steelmaking coal demand, and we have supplied an increased proportion of lower grade steelmaking coal to customers responding to that demand.
Was it really lower grade coal, or did you sell it as lower grade coal because that's what the customer wanted?
It was lower grade coal.
Great, thanks, Réal.
How would you characterize the preference for Chinese customers versus Japanese customers in terms of coal quality?
The Chinese market is supplied pretty well domestically with lower grade type coals. They have limited reserves and availability of higher grade hard coking coal, so they turn to the seaborne market mainly to import higher grade steelmaking coals.
Thanks, Réal. Back on your slide 11, you talk about the capacity utilization in steel mills having an effect on the ratio of hard coking coal versus lower quality coals. Just curious to see if you could tell us what that capacity utilization rate is, more or less, with the ratios that you have here.
So capacity utilization rate for 2013 is somewhere in the low 80% level. Around that level, it is easier to use lower grade coals. If you can imagine, when some steel producers are running at lower capacity utilization levels, they're not pushing productivity as hard. So that's the reason behind the steel makers being able to use more lower grade coals in their blends. Does that answer? Okay.
How many more tons of met coal seaborne supply do you think needs to come out of the market? And depending on the answer, where do you think it will come out of?
What do I think about what?
Which geography will be cutting back supply?
Okay. So to date, there's been cuts of about 40 million tons of production, and most of that has come out of the U.S. Expectations from various people in the industry is that there will be further production cuts coming out of the U.S. between now and the end of the year, to a level where it could bring supply exports out of the U.S. to somewhere in the mid 50 million tons. We've also seen estimates looking out into next year where those exports out of the USA could be as low as the mid 40 million ton levels.
So am I right in understanding that you think about 10 million tons will come out of U.S.?
It's possible, yeah.
And those same producers that have cut back 40 plus another 10, if those happen, if metallurgical price starts heading back up, do you envision them bringing that supply back relatively quickly? Why not?
So just one point to clarify, the 40 million tons that have been cut have not all been from the U.S. There's been cuts in Canada, there's been cuts in Australia as well. Now, what price will do, I guess it all depends to what pricing levels can get to, and then it's a little bit tough to comment on what other companies might decide to do in terms of their production. But usually when prices are coming down, tons are slower to get out of the market. When prices are going up, they're slower to get back in the market.
It's slower. Are we talking months or much closer to, I don't know if permanent, but substantial?
And I suppose some closures could be permanent, some others could be depending on where price levels get to.
Hi, Réal. I was wondering if you could address some of the topics going on in China with their ability to increase coking coal production over the next several years. There's been talk about new rail lines being built, and that'll increase their ability to get steel or coal to the port. And then there's also been more talks about consolidation efforts regarding safety and potentially closures of more mines in China. Thanks.
So there's been consolidation going on for a few years in Shaanxi province. Shaanxi province is the larger producing area for steelmaking coal in China. Consolidation is underway, but there's also been certain delays. It's taking longer than expected, and it's been pushed out a couple years. Now, when we look at the next few years, we're expecting domestic production, mainly out of Shaanxi province, to increase, but to increase at a lower rate than the steel production is increasing, so creating more space for imported coal. The other thing that is happening in China, I think Don alluded to the new leadership and the direction that they're taking with respect to industry and environmental protection, sustainability, basically. So there is new regulations, for instance, in Tangshan area, where coal and coke carrying a sulfur content of higher than 0.6% will attract significant penalties. As more and more of that is happening, it's also impacting the ability of Chinese steelmaking coal producers to supply. When you look at the supply of the coal, the domestic supply in China, a big portion of it is higher sulfur material. The Chinese steelmakers are turning to the seaborne market in order to get lower sulfur material and also higher grade steelmaking coal.
Great, thanks very much, Réal. We're going to take one more question and move on, and we've got more question time coming up at the end of the day as well.
Hi, Réal. Jorge again with Deutsche Bank. I just was asking about slide 14, where you give a pretty good forward outlook on slide 12 for what you see to be the future demand, but your graphs on slide 14 stop in 2012, and Australia looks like it's been underproducing relative to its potential for the last few years. We're aware of new projects coming on, also in Mozambique. Could you just kind of talk about what you see in terms of global supply coming on from those two main regions over the next 3 years, because that's really what's going to fundamentally determine supply-demand balance.
Okay. So in Australia, in 2013, they now appear to be on track, be back to pre-flood levels. when you look at the projects that have been announced when the market was when pricing in the market was near peak levels, a lot of those projects have actually been cut back or simply canceled. There's still additional production that will come out of Australia. For instance, BHP Billiton, I believe, announced that they will go ahead with Caval Ridge, so that production is expected to come on. Poitrel Mine has started this year, that is adding production again into the market. So we see Australia basically remaining the largest supplier in the seaborne market. They currently supply about 60-65%, and it will probably remain quite similar going forward. In terms of Mozambique, the key challenges in Mozambique are around logistics and the release of the coals. We understand that the rail line to Nacala Port, so it's going north, is being built. Investments have happened, especially from Valley. And we're expecting to see more tons come out of Mozambique, but likely will take a little bit more time than when those original projects were looked at.